Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of August 31st, 2025. It's just myself, Sprocket888 this week, and I'm going to do a quick episode around earnings and the inflated premium that happens as we approach earnings, and kind of talk through and show some of the examples of what do I mean by inflated premium. It's something that is builds and builds and builds as you go into earnings, and then after the earnings, the volatility really kind of deflates. And I'm going to look at playing both sides of that, buying the volatility and selling the volatility, and really ask the question, is it worth it to engage? But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know, and we will get it there. But let's hop to this week's content. In this week's content, I really wanted to focus around earnings and the premium that is built into options around those earnings. So we're really kind of winding down the earnings season here for the quarter, and there's still a good couple of earnings announcements coming up yet. And so there's still more time to play. But I was really having a conversation recently with a friend of mine, and we were kind of talking about premium. And he knows that I'm a big premium seller. And we were having a conversation. He says, "Oh man, I recently bought some options going into earnings." And he goes, I don't know, I'm kind of regretting it. And so I thought about that, and I'm always a premium seller, and so I don't want to really necessarily tilt this one way or another, but I am biased to premium selling. But that's kind of because I fundamentally look at how that premium works in the option leading up to earnings. And I think there's ways that you can buy that premium, and I think there's probably situations that you might want to. And that's really what I think is one of the wonders of the market. Is it's so wide, it's so vast, it's so infinite as far as all the different combinations and strategies you can deploy. There's really nothing that says my way of premium selling is the only way to do this. And there's reasons why I do that route, but there's also reasons why somebody might take the other route and buy the option or buy the premium that is being inflated. And that's really what I want to focus on in this episode, is just kind of talk through the mechanics of what's kind of happening behind the scenes with that premium as it kind of goes into earnings, or really for that matter, any binary event. So you'll see this similar activity happen very frequently in pharmaceutical stocks, bio stocks. They have some sort of drug trial or things like that, where there is a date that is a known date where they're expecting some sort of news around that. And that uncertainty from the news will really kind of build volatility, build premium in there, because it really could be a violent move up or down, and you really don't know. And that's what gets priced into the option. So you've heard me kind of talk about on the show before that options are really a lot like insurance. If you live in an area where you have a home, you have homeowners insurance, but the area that you live in is prone to natural disasters, hurricanes, earthquakes, tornadoes, things like that. There are statistical probabilities that the insurance companies will likely have to pay out. And so the premiums in those areas are higher than in premiums that have less natural disaster, less theft, less things like that, because the insurance company have a lower probability of having to pay those things out, so they don't have to charge as much premium. The idea with the insurance companies is they charge enough premium to kind of collect and have a cash backlog, so that when they do have to pay out for the off chance that one of those homes or something make a claim, they have the capital on hand to file that claim. And that's really all about how insurance companies are kind of out there. And the same thing goes for uncertainty in an option. The more uncertainty in around a binary event, the more that people aren't sure what's going to happen, the more volatile it can be. And so there's more premium as there's more risk, because there can be more movement baked into that. And that's the whole premise of the premium component of option selling, or option pricing, I should say, not even selling. Now, there's another very, very important component that goes into option pricing, and that is time, the time left before the option expires. And I'm going to touch a little bit on this, but I'm not going to dive deep into it. That is called theta. And so the longer that the option is out there, or the longer that it's good for, the more theta that it has, the more time premium it has. So think of it like a coupon that's going to expire this week. That coupon might not have as much value because you might not get the opportunity to use that coupon in such a short amount of time. But if I can extend the length that that coupon is good for, it has more value because it gives you more flexibility on when you might want to use that coupon. And that's going to be an important factor to remember because we can kind of do some interesting things when it comes to volatility and expected price movement and the impact that it has on the option chain. Now, the first part I want to call out here is when we have earnings, a lot of times you will see elevated volatility. And so there's two underlyings here, and the name of what they stand for really doesn't matter for this example. And so I'm going to switch over here, and I'm going to show you the option chain that I'm talking about. Now, this option chain, there's two different chains, but what the important thing is this column on the right-hand side of each. That is the volatility in the option that expires on the date that's on the left-hand side. And so on the left, you have September 5th. So that is a Friday. And notice that the volatility in that week's expiration is 130%. If you kind of look down as you get further out in time, you notice it kind of settles out around 60%, between 60 and 70%. So that might be the normal resting volatility for whatever this underlying happens to be. And you can see that this particular earnings announcement here is basically doubling that volatility, or doubling that kind of premium and expected move potentially. The number out here is the expected move by the end of that expiration. And so it's kind of interesting. This is about $7.60. So while this is only 8 days to expiration, that's what the 8 here means. It means 8 days away from expiration. It says, hey, in the next 8 days, this underlying could go plus or minus $7.60. That's what the option chain is telling you. Now, what's interesting about that, and this 130% is the volatility or momentum that could be behind that spring-loaded action. But if I come down here to October 10th, so October 10th is actually 43 days to expiration, 43 days away, and it's saying, hey, 43 days away, this underlying has about expected move of $7.85. So that's out another additional like 37 days, 35 days out, but the expected move is the same as what's expiring this week. And that is what the difference in this volatility number is. So this is 58% volatility. This is 130% volatility. So that volatility is the magnitude of what is getting priced into that option. And so it's very important that you recognize that this volatility is extra extended. The reason that's important because that has a direct and very substantial impact to the pricing of the option. Now, on the right-hand side, you can see this underlying actually doesn't have earnings at any point on this chain, and you don't get a ton of spike in volatility. It's a little bit higher, but not by much. Here you got 58%, 63%, 65%, 60. So this is a relatively stable volatility. And yes, this top number is a little bit higher, but it's 1 day to expiration, and really those things can kind of bounce all over the place. And so when you are going into an option chain and you're buying or selling the option, doesn't matter. Just recognize that when that percentage is higher like this, means substantially higher than other portions of the chain, you're paying a significant premium to buy that option, or you're collecting a significant premium if you're choosing to sell that option. Now, where I want to go with this is I want to take and look at basically 4 scenarios here. First one is going to be buying and selling on things that have elevated volatility. What does that look like? What does it look like if I buy an option? What does it look like if I sell an option? And then I'm going to do the same thing for when there is not elevated volatility. What does that look like when I buy an option? What does that look like when I sell an option? And I really want to kind of dive into that so you can get some numbers behind it. And I'll talk a little bit about what assumptions I'm making. And this is very much for example, and the calculations are actually a little bit more difficult to come up with live, but the general premise of this and the idea of this will hold true. And if you don't believe me, I encourage you to go paper trade this stuff. You will experience this firsthand of what I'm talking about. So what I did for all the examples here is I assumed I was going to use 25 delta strikes. What that means is when I was looking at the put strike, what put strike do I use? It's whatever that 25 delta is. That means 25% chance that it's going to hit that number, whether that's on the put side or the call side. Then what I did is I said, I'm going to operate on the thesis that the underlying is going to see a 20% upside move. So I'm anticipating a significant upside move in this option strategy that I'm putting out there. That's kind of important because usually if you're buying options, what you're typically doing is you're buying cheap out of the money options, hoping that you're going to get a significant move in your favor. And then that option is just going to really multiply in value, and you're going to return 10, 15, 20x what you put in. And that's really because they're very, very leveraged. That's what a lot of people are kind of going for. So we're going to assume that a 20% upside move, which is a very substantial move in an underlying. And then the last number here is what the underlying strike is at the time that I set a lot of this analysis up. And so one thing before I go through the table at the bottom on what all of that means, these two charts at the top, this is the profit and loss chart. So you can kind of ignore the purple line. That purple line is what the value of the option is at this exact moment. The blue line is the value of the option at expiration. And so the current price of this is 49. So it's basically right over here on the right or the left side of this chart. And this basically is buying a call. And if you buy the call, this gray line here is your break even. So if you buy the call, it costs you money to buy it, right? So that's a debit. But you don't actually start making your money back until you hit the strike price. But even then, you have to appreciate past the strike price by the distance that the call is before you actually hit your break even. Now, once you hit that, it's a linear shot up from there on how much money you can make for how much it runs. And there's no limit to that because there's no limit to how high a stock can go. On the chart on the right, this is actually a put selling. And so in put selling, you're basically saying, I do not believe this price is going to go lower than my strike price. So in this case, you collect money at the time of open, and that's the maximum money you can make on it. And so the trade is all about keeping that initial premium that you collect. And so here you can see no matter how high this stock goes, you will never get more than that premium that you had collected. And so that's the premise of the profit and loss charts. So let's talk a little bit about this table down here, because what this table is doing is it's looking at two particular scenarios, one the buy, one the sell, but it's also looking at playing the option that is immediately expiring in this current week, and then also playing something that's out further in time. So less volatility, more time premium, and it's not that increased immediate elevation. So we went with September 5th is the first two rows, and October 17th is the second two rows. So first example here, if we sell a put, that says, what is the 25 delta put? Well, that would be $44.50. So you think this thing's going to go up 20%. So you go down 25 delta and you say it's not going below $44.50. And what do you collect for that? In this example, I would have collected $1.53 per option contract. Now, that $1.53 is $153 because each contract represents 100 shares. So in this example, I would have collected $153 on day 0. So we go by the week, the end of September 5th comes around. We assume that we got that 20% upside move, which is a $9.80 move upwards for a $49 stock, which means we're going to be sitting significantly above $44.50. But doesn't matter how high the stock goes. I sold the put. So my max profit is basically $153. Update that to 153 total. So yes, now this whole trade, $153. Now the probability of that happening is 75%. And that's derived from the 25 delta, which means there's a 25% chance that that strike would have been in the money, which means there's a 75% chance it would have been out of the money, which is where we landed. So next scenario, what happens if I didn't sell the put, but I decided to buy the call? So the strike price that I would buy would be 25 delta because I'm buying an out of the money call. So it's going to be 25 delta out. Now that delta is directly related to the percent of volatility. So when that volatility is really high, those deltas become very, very far apart from where the underlying is. If that percentage was very small, it's less of a move from where the price is. So in this case, the 25 delta strike was at $57. Now, remember, the original one was at $49. So a $9.80 move is going to come into the money by about $1.80. So it's going to cost me $1 to put that trade on. So I'm going to fork over $100 to put that trade on. Now, if the stock doesn't move, if it goes down, whatever, I'm out that $100. I don't get that money back at expiration. But if I get my move, that is the expected 20% move, $9.80, I'll be $1.80 in the money. So I'll get to collect $180 in the money from that option that has moved in my favor. Cool, right? Well, don't forget, you got to take off the $100 that you decided to pay for that option because, that is part of that debit. So you have to add those two things together. Yeah, you collected $180, but you had to spend $100 to get the $180. So you're left with a net profit of about $80. Now, the probability of that happening is about 25% because that was a 25 delta, and that option chain is telling you there's a 25% chance that will finish in the money. Okay, now let's go down to October 17th. So if you remember, that was a little bit further out in time. But let's say that we're going to buy and sell that option, but we're still going to close the position out on September 5th because we're expecting our move to come right after earnings. So this is kind of like, hey, instead of playing this exactly week of expiration, let's play this out a good bit of distance where that volatility is more normal and not elevated for earnings. So in the selling version, we're going to sell basically a 42.50 strike. That's what the 25 delta was. We're going to collect $2.15. So we're going to be plus $215. Now we're going to assume that we're going to get our 10% move, 20% move, I'm sorry. Now that put is actually still going to have value. So if you want to close it out, you're going to have to buy it back. Well, that put will have about $25 of extrinsic value in it. So you will have collected $215 from your initial sale, but to buy it back to close, you're going to have to spend $25. Because remember, we're playing this the week of expiration, even though this doesn't expire till the third week in October. So I add those together and I have a net profit of $190. Not too shabby, 75% chance of hitting that number. So now let's look at the call, because here you notice that the call premium really ate into your profit. So if we go out in time, how does that factor into the profit which we might receive? So here our strike will be $62.50. So because we're further out in time, that's a significant more move, and that's not actually going to cover as much of that $9.80 move off of that $49. So I'm going to spend about $150 to buy that option. Now, the good thing is we have a lot of theta, a lot of time. And so when you take the time premium plus that movement, that option that we bought is actually going to be a lot closer to the money. And it's still going to have a lot of time premium. Now, it's not going to be in the money, but because it's going to be closer to the money and the time premium is so vast, it's actually going to appreciate in value. And we'll have about $370 collected from that. Now, we had to pay $150 to get that $370, but now we're looking a little bit more respectable. And so we will have collected about $220. And again, there's about a 25% chance of that. Now, if you look at this, one observation you might have is, wow, I can get, yeah, it's a little less, but still decent with a much higher percentage of probability here selling. And you'll notice it's actually even more money on the selling here. But that kind of goes into it. This is what it looks like with elevated volatility. This is one of the reasons why I am very much selling premium, but only when the volatility is extended. So let's look at the next situation of when volatility is not extended and we have a pretty equal distribution of volatility on the option chain. So this is going to be that example on the right at the beginning. And so this particular underlying was at $26. We're going to use the same assumptions. We're looking at the 25 delta strikes, and we're going to assume a 20% upside move. Now, this is a smaller underlying, so this is a $4 move to the upside. So let's look at week of expiration. I'm going to, say this is going to be the $25 put. That is about the 25 delta per this option chain. I'm going to collect 39 cents, which is $39. So after a $4 move to the upside, I will be left with $39 because this price does not change no matter how high the stock goes. And the total of that, because I didn't pay anything to enter, I keep every penny that I had where expired, is $39. 75% chance of making $39. Cool. Well, what happens if I buy the call? Now remember, the premium is not elevated this time. So the expected move takes me to a $28 strike. But if we, and that's going to cost me $35. So I'm going to pay $35. But if we get that 20% upside move like we are expecting, that's a $4 move up. That option is now $3.70 in the money. And so I'm going to collect $370. I had to pay $35 to put the trade on, but I'm going to have a net of $337. Wow, this looks a lot different, doesn't it? So when the premium is low due to volatility, you're going to collect a lot more if you get the move that you want because you're not fighting all of that inflated volatility, which is directly impacting price. Now, what if we try to go out and kind of neutralize some of that a little bit in this case? So October 17th, we're going to sell the put. We're going to collect $95. Now, when we go to buy it back, there's still going to be, even after our 20% upside move, there's still going to be value left in that option. So it's going to cost about $25 to close it. You're going to add that onto your $95, and you're going to net $70 profit. So if we flip that to buying the call, the 25 delta call will be a $31 strike. It's going to cost us about $85 to buy that call. But if we get our $4 move up, that call will have about $1.96 in value that we can actually sell back at that first week after the price move, netting us $111. Now, there's only a 25% chance that that's what was going to happen. But notice here, there's a lot more payoff or a lot higher multiple for this 25%. Yes, it's still only a 25% chance of getting that, but there's a significant difference between, hey, a 75% chance of getting $39 or maybe take a smaller gamble, pay $35, and you might come home with $337. So notice that difference of without elevated volatility. We're going to flip back up here to with elevated volatility. And again, there's not so much of a difference here. In fact, if you buy the call here, you have less of a chance of hitting your $80. And if you play it the other way, you have a 75% chance of making $153. So you can see there is a significant difference in the potential outcome simply based on that volatility number and how elevated is that volatility relative to the normal volatility of the option. Now, is one of these ways right and one of these ways wrong? Absolutely not. But what I want to highlight there is the fundamental understanding of how this volatility impacts the price of the option, because the price of that option is directly going to hit your profit or loss depending on whether you're selling that price or buying that price. Now, you could counter argue this and say, well, Sprocket, the reason I buy when volatility is really high is because that means there's a lot of explosive growth, explosive price movement that might come out of that. That's true, because if you have an underlying that has lower volatility, the expected move is going to be lower. But if you actually get that surprise outside of the expected move, you're going to make bank if you got the direction right, because the price of the option wasn't taking into account that dramatic of a price movement. Whereas when you sell the option, you actually, in my opinion, are taking on more risk by selling an option that has lower volatility, because there is a higher chance that the volatility that is priced in is going to get run over by an unexpected price movement that's not priced in, which is why buying an option when volatility is low makes a lot of sense, because maybe there will be a surprise upside. And if there is, you're not going to fight that already inflated expectation of a large price movement. And that's really the trade-off that you're taking here. And so it doesn't mean that buying options is right or selling options is right, or selling them is wrong and buying them is wrong. Doesn't make that at all a thing. It really goes down to understanding the mechanics that's in there, and what does that mean for you? What does that mean for the thesis that you want to project onto the market, of how you want to play that? So that brings us to the end of this week's episode. Hopefully this gives you a little bit of insight into what does this volatility mean, and why does Sprocket always target things with elevated volatility when he sells them. And this really, I hope, can illustrate the benefit or the probability that's in your favor, where that risk to reward ratio tends to happen to tilt the scales ever so slightly when the volatility is elevated abnormally from the historical levels. And that's really when I engage in selling. Do I engage in buying? Not very frequently, but if I was to engage in buying, I'm going to pay close attention to the amount of volatility and that's priced into the option, because that is a premium that I have to pay, that I will have to fight. If I get the movement that I want, I've got to battle back that premium that I paid before I can really actually make a profit. And it's just something to consider when you're deploying your strategy out there. So hopefully this was insightful to you, and you're enjoying the market, and you're able to find the strategies that work for you, and you're having fun out there. So good luck, have fun, and remember, think outside the block.